Well, welcome back to Finance Uncut. On today's episode, 12% inflation, interest rates rising, market crashes. Where do we invest? In this video, we've got warnings from Mervyn King, Jamie Dimon, James Gorman, the real Bond King, Jeff Gundlach, Dr Michael Burry from the Big Short fame, and we've got some exciting and interesting gold charts to have a look at. But first, let's cut to a clip with billionaire investor Kyle Bass.
The May producer price index coming in hotter than expected. Joining us right now to talk about this new inflation data and what it could mean for the markets and the Fed as the central bank kicks off its latest two-day meeting is Kyle Bass. He's founder and chief investment officer of Heyman Capital Management. And Kyle, what do you think? As somebody who's looking to invest in the market, what do these hotter numbers mean? What does that mean for the Fed?
I mean, first of all, Becky, I think it's when you look at the inflation numbers, these are chain-weighted inflation numbers. These are numbers that are designed to artificially be low. If you look at a non-chain-weighted index of inflation, we think it's running about 12%. And with short-term interest rates still at zero, that means people that have money in the bank or in their savings are losing, call it 5 to 12% of their purchasing power now annually. So we have 34% more money in the U.S. system than we had 14 months ago. Of course, we're going to have inflation, and it's going to be significant. And I think investors and savers, retirees really need to think about how to maintain the purchasing power of their capital. I think there are plenty of interesting places to put it, and some of them might not be in the market.
Where? I mean, inflation itself is an argument for not keeping cash around.
No, I agree. You have to be invested, given the amount of capital that's in the not only the U.S. market, the global market. Looking at the global central bank's response to not only the virus but also back to even the financial crisis, in 2008. I think that we're going to launch a private equity firm to kind of stay ahead of inflation and invest in the environment and environmental remediation. Given the nonlinearity of population movements around the U.S., there are plenty of things to do where I think you can stay ahead of the inflation curve. Typically, stocks keep up with about 85% of inflation, so you're not going to lose too much by owning the market vis-a-vis inflation. But I think you're going to need to make mid-teens numbers just to break even, given the numbers we're seeing today.
Man, that's a pretty lousy argument for investing. You're not going to lose too much money if you're invested in the market. I mean, Kyle, what do you think happens with the Fed at this point? And I bring this up because Jamie Dimon made some comments about how he thinks they're keeping some cash around right now because they want to be able to plow into the rising interest rate structure as the Fed really has to sit up and pay attention to this inflation.
Yeah, I think if you just look at retail sales, right? Retail sales are at new all-time highs in nominal terms today, much higher than they were pre-pandemic. And we still lack about 8 million jobs. So it's fascinating to see kind of the net results of such Fed largesse and the money that they've printed, really generating a monster nominal retail sales number in the absence of jobs. So I think we're in a new world where, unfortunately, the wealth gap's going to widen, the income gap is going to widen, and we're going to see more social pressure in the markets. But when you look at the Fed itself, I think that the Fed's got to look at housing. Housing's in very, very short supply in many places in the country, and yet the Fed is buying $40 billion of mortgages in new mortgages per month. They buy $6 billion a day when there's housing unaffordability everywhere. I mean, there's some policies that I deem to be inconsistent with, let's say, rational behavior. So I think the Fed's going to have to make some adjustments in its plans going forward.
And what will the market's reaction be? Because we're getting to this point where the Fed is going to have to make some sort of a pivot. As an investor, when they do that, what does that mean? Will the market handle this smoothly, or will investors and market players move immediately to try and get to the terminal point?
That's a good question. I mean, we've all seen what's happened in previous, what they call taper tantrums. And you've seen, 10, 12% pullbacks in the market. Would that be healthy? It'd be healthy. It'd probably scare some people. But I do think that in the end, you can't worry about the market's every move. I think, in real terms, we have negative real rates, we think, of over 10% today, meaning you're losing 10% of your purchasing power annually at the current moment. And so negative real rates are pretty repressive. And when food prices start moving like the UN Ag and Food Index has moved in the last, call it 5 months, that's a huge regressive tax on the poor. And I think the Fed's got to really start thinking about food prices.
So Kyle Bass isn't the only one saying that we've got 12% CPI inflation. CPI, it's not inflation. We know what inflation is. If you don't know what inflation is, check out my video that I did ages ago about what is inflation. Anyway, John Williams from Shadow Stats just did a recent interview. I'll put a link in the description below because it was a really, really good interview. If you want to go watch it, I can't even remember off the top of my head what channel it was on, but I'll put a link in the description below. But he's saying that we've got CPI at 12-13%, pushing 15%. Make no mistake, the risk of inflation is real, from Mervyn King. I'll put a link in the description to a Financial Times article that he wrote in that, where, he's saying that absolutely we've got inflation. And when we look at businesses, they're responding to higher wages with higher prices. And you can see that on this chart that prices have increased and compensation is starting to increase as well. And here in Australia, we've got some big inflation issues coming down the pipeline. And some of our big retailers have already now said that they will be passing on higher prices due to their costs. And just the other day we had the Fair Work Act, or the Fair Work Commission, increase the minimum wage by 2.5%. But I'll save that for a video next week on the Aussie economy. I've been putting a lot of research and putting together this video next week on the Aussie economy. And you're going to hear things in this video that you just will not hear from other Aussie economists out there. So stay tuned for that. And even if you're not an Australian, I think you'll enjoy it, because I think it's got a lot of similarities to other nations around the world. And here we can see a good chart here. Finished goods and CPI headline inflation. I hate using that word. So we can expect CPI, consumer price inflation, heading higher from here. Now, someone pointed out to me that in this chart, going back when we had that last spike in finished goods in the PPI, that we were then faced with the global financial crisis. And they're arguing because that PPI has apparently tipped downwards, that we're likely to see something like that again. And I don't rule that out. However, I saw this article from Jamie Dimon saying JP Morgan is hoarding cash because very good chance inflation is here to stay. And I got really confused. I saw the headline. I was like, that makes no sense. If you think inflation is here to stay, why would you be hoarding cash? And so I read the article, and a couple of things stood out. As well, I saw a piece, a video from the Morgan Stanley CEO, James Gorman, who's also an Aussie. So let's cut to that short little video now and see why Jamie Dimon is hoarding cash, even though he thinks inflation is here.
James, great to see you. Thanks so much for joining us.
Great to be with you, Wilf.
We wanted to kick off, if we can, on macro topics with a Fed meeting coming this week. You've raised some eyebrows of late at a conference in Tokyo, saying you think rates will move higher early next year as opposed to later than that. And described yourself in your conversation with Betsy today as a hawk a couple of times. So talk us through why you have that view and how it's altering your behavior as a CEO.
Sure. Well, we're in a very unusual situation. We have record low rates, historically low. We have record high fiscal stimulus, and we have synchronized recovery of the global economies. Not every single country, but most countries. And I just heard the comments about Europe, and Europe's following the US, which is following Asia. So there's an enormous number of positives going on right now. We're seeing inflation creep in. And the question is, when does the Fed move? It has to move at some point. And I think the bias is more likely earlier than the current dots would suggest rather than later. And that's what I expressed. Obviously, I have no special wisdom on it, but my gut tells me this economy is recovering faster, inflation is moving quicker, and it may not be quite as transitory as we all think.
So do you think that we're therefore in an era potentially of a major policy mistake by not starting that process sooner? And do you think that equity markets will correct meaningfully when or if they come to join you in your current opinion?
I don't think it's a policy mistake. No, I think these are judgment calls. And listen, the Fed has a deep responsibility to help the U.S. economy recover and to get people back working. And as we know, employee participation is not there yet. So we'll see when the extra bonus, if you will, comes off in September, how those numbers change. Right now, if you go anywhere around the country, there are help wanted signs everywhere. But no, I don't think we're at a policy mistake by any stretch. We've still got plenty of time for the Fed to move. I just think my bias is it's likely to happen sooner rather than later.
James, it's Sarah. I just wanted to follow up on something you just suggested, which is that you don't think inflation is necessarily going to be transitory. Why do you disagree with the Fed and now the markets, the bond market on this point? What do you see?
Again, Sarah, it's my judgment from looking at the numbers, looking at how the economy is behaving, and looking at the kind of inflation that we're seeing, which in very short term is extremely high. So how that rebalances with all the disruption to the supply chains and what's going on in the commodities cycle remains to be seen. But my gut is not all of it is going to go away as we'd all like in the next several months.
All right, so James Gorman from Morgan Stanley thinks that the Fed is going to raise rates a lot sooner than expected, and if we look at what Chairman Powell said the other day about them raising rates earlier in 2023, but tapering early next year in 2022, we saw the markets didn't like that. So that explains why Jamie Dimon is saying that we're hoarding cash, because not only did he say that inflation's here to stay, he thinks that the Fed is going to lift rates earlier as well. So he's with Morgan Stanley. He thinks that interest rates are going up and therefore asset prices are going down. And also they don't want to hold bonds. And that's interesting because Jamie Dimon a little while ago, I remember him saying, bonds are rubbish. Why would you hold bonds right now? Blah, blah, blah. They can, if they wait, then perhaps they could go back into the bond market at much higher yields. And then, if central banks, start pushing yields down again, then those bond prices could rise. So whether they're doing that or whether they're just storing cash to buy other cheap assets, whether it's stocks or other assets, not too sure. However, we've got this warning. Jeff Gundlach, the real bond king, not the pretend or self-appointed bond king, says that the 5-year US Treasury yield pushing above 1% would be a big deal. So, folks, this is now on my radar to keep an eye on the 5-year US Treasury yield. And I'd suggest you do that as well. So I've shared this chart before. Are the markets juiced up on central bank liquidity right around the world? And if the central banks are going to, there's talk in New Zealand that they're going to lift rates in February 2022. So they could be the first central bank to lift interest rates. But even with the tapering, could we see asset prices like stock markets have a significant fall? The argument's out there that it's central bank liquidity that is juicing these markets, and it has really been juicing, along with perhaps stock buybacks. Also next week in my video on the Aussie economy, I'm going to touch base on actually zombie companies and zombie companies in the US, and it's actually quite surprising the number of zombie companies that can't even pay their interest bill, let alone principal, at these interest rates. So it's going to be interesting times ahead. When we look at the market, we can see that it's really, the Fed has juiced it up, but also there is so much margin debt in the system. Have a look at the margin debt, or the credit, negative credit balances today compared to back in the tech bubble. And just have a look at the growth, really, from post GFC, from about 2010 onwards, just the growth in leverage in the market, and we know if that starts falling, with any significant numbers, margin calls are going to happen, and it could get really ugly. So let's see what central banks actually do. Because some are saying that central banks can't raise. They just can't, and they won't, because they will pop the everything bubble. Others, Luke Gorman and others, are saying that they disagree with Lynn Alden's, I guess, 1940, where we had high debt levels and central banks were able to keep rates on the floor. Is that was also prior to the Eurodollar system and the petrodollar system, and the amount of debt and the amount of derivatives in the marketplace now, and that they wouldn't be able to do yield curve control moving forward. But anyway, let's wait and see. The Buffett indicator, as of June 10th, the market value to GDP, 233%, 87% higher than the long-term trend line. You can see it's much higher than the dot-com bubble now. This is one reason why I struggle buying, stocks outside of gold miners, silver miners, gold explorers, silver explorers, and other commodities, and a little bit of biotech. That's basically my stock portfolio. I don't own any other stocks in any other sectors and whatnot, because everything's overvalued. And buying at these levels, your future returns over the next decade, I think you can see what I think on that. When we look at the S&P 500 versus real earnings yield, the real earnings yield has never been this low, and whenever it has gone negative, it's always led into bear markets. So the warning signs are there. When the real dividend yield goes below 2%, always tends to lead into a bear market as well, and that's where we are now. So warning signs. Dr Michael Burry tweeted this out. People always ask me what is going on in the markets. It is simple. Greatest speculative bubble of all time in all things. by 2 orders of magnitude. So that's Mr. The Big Short man himself, saying that we're in the greatest speculative bubble of all time in all things. So it's the everything bubble. I think it'd be wise listening to some of these people who have had a lot more success than myself. I'm an amateur in comparison to the Bond King and Dr. Michael Burry. And Chris Coles just recently tweeted this week that rapid inflation leads to credit solvency problems, and credit solvency problems lead to illiquidity, and illiquidity leads to volatility, and volatility leads to the dark side, and the dark side leads to more Fed bailouts and more income inequality. And he actually argues that the stock market crash in '87 was due to actually rising inflation or CPI, and then the Fed rising or nominal yields rising, and that is what actually crashed the 1987 stock market bubble. So what do we do if the 1987 stock market, if we're going to have something similar to that? We've got this inflation. Central banks seem to be saying that they're about to taper and about to hike soon. How soon? They did say 2024. Now they're kind of saying 2023. Possibly 2022. Let's see. So when we look at gold versus the S&P 500 and treasuries during crises, 1987, the S&P 500 during that time period there fell 33%. US treasuries fell as well, and gold did all right. Gold went up 5%. Gold went up 5%. So you can have a look at all these other, you might want to pause the video right now. Have a look at all these different times, these different crises happened, and you can compare the S&P 500, the returns, and the US treasuries and gold. Overall, during these crises, the S&P fell 19.4%. US treasuries did okay, 3.9%, but gold 6.8%. So, I like holding gold. I like holding the physical. I like holding gold and silver mining shares and explorers for that leverage. More of a specky play, but with a bit of experience in that field, you have some success. Have a few losses as well, and performance of hedges in market sell-offs. Once again, just different periods there. And have a look at the stock market, what it fell. Have a look at the US 10-year bonds and the 3-month treasury. So those notes, and look at gold. Gold did well. So once again, people say you don't want to own gold. Gold does well in deflation, does well in inflation. Gold does really well when there's uncertainty and crisis happening around the world. And let's finish this video with one of my heroes, Dr. Ron Paul, because gold is honest money. It is disliked by dishonest men. So true. Anyway, guys, if you like this video, please hit that like button. It really does help the algorithms, I'm told. If you haven't yet subscribed to the channel, do so. Hit that notification bell. Take care, everyone, and I'll see you again on another episode of Finance Uncut.